what impact does the LVR or the loan to value ratio have on my mortgage?
Good question. So, if you bought a house over the last 3 or 4 years, you've probably got more than 20% equity now, even if you purchased it with a 5% deposit, because the value of the properties have gone up so high. So if you've got more than 20% equity, so if your house is worth 500 and you owe less than 400,000, that's 20%, then play on. There is no impact to that. In fact, the more deposit you've got or the more equity you've got, so if you have 30% equity or a loan value ratio of 70%, then potentially some lenders will give you a lower interest rate because you're lower risk and the bank can see there's a better ratio in terms of equity versus the loan amount. However, if you potentially bought something and the place you bought hasn't gone up in value and you're still around that, above 80%, 83%, up to 95% loan value ratio, so you would have paid mortgage insurance maybe 6-12 months ago, or you were part of a government scheme where the bank, the federal government actually guaranteed that portion of the deposit to allow you to purchase the property. If you went to refinance to a new lender and they value the property and you're still under 20% deposit, you would have to pay mortgage insurance again because the new lender is a new valuation, you're a new client to them, they basically have to rewrite the loan and you'd have to pay mortgage insurance. So normally people wouldn't refinance until such time as they hit 20% equity to allow that to happen with the least amount of fees. And also the lowest interest rate that they can get hold of. But the best way of doing that would be to contact a broker like us and we can get a valuation done, get across your numbers and just see whether or not it's worthwhile having that conversation to move you from one place to another.